I'm wondering if you could maybe give us a sense of the size of checks that you guys typically invest and what the size of the fund is you're investing, maybe what those economics look like.
Yeah.
My basic understanding is we're talking about private equity funds that might be on the low end a couple hundred million, maybe on the higher end a couple billion. Is that in the range that you're
That
are
that
aiming
that
for?
is generally right on the fund size for most of our vehicles. We have a large number of vehicles on our side, and they span a lot of different, purposes, size, scope. Some of them are wildly diversified, and some of them are specific to single assets. So again, without giving any kind of specifics, our business is really unique. We have no restriction on our side to only invest in something of a certain size, to only invest in one type, to only invest in one sector. We have total freedom to do whatever makes the most sense and what we believe will be the best investment. And sometimes that actually involves doing absolutely nothing. And that is equally as powerful, right? We don't have a need to do anything or to deploy anything. All we can do is make the best investment choice, knowing what we know about the broader world, knowing about about our existing pipeline of deal flows, et cetera.
I'm not super familiar with the GP stakes business, but my understanding is a manager, when they're getting a firm started, or maybe after they've gotten a few funds off the ground, they might value their business at, say, 20% of capital under management, plus or minus. And I'm kind of guessing you might write them a check for 20% of that value. Is that sort of the rough story? Or am I, off base
You,
there? Or is
you're
that,
you're
how
you're
you think about it?
directionally correct in the numbers, but the math behind it is actually more complicated. So I'll touch on
Okay.
maybe the thought process on how a GP stake is valued, and I'd also like to touch on the rationale on why a firm would pursue a transaction like that, which is probably the most crucial question. So on the
Right.
valuation side, it's actually no different than really any kind of fundamental finance exercise, which is project out future cash flows, discount those cash flows back, and arrive at a net present value that is effectively what you would pay for the
Yeah.
business. And so that involves projecting out management fees, which are contractually obligated, they're highly durable, they're revenues that are effectively forecasted out and locked in for 5, 10 years plus in some cases. That's a really predictable bond like cash flow. Very simple,
Right.
very easy to predict as long as you know how fast the firm will grow. The carried interest or the performance side is more lumpy, and it
Right.
relies on harvesting underlying companies that these firms invest in and then ultimately sell. And so that itself is a mathematical exercise. It looks smoother if you look at it over the entire firm, but generally speaking, it relies on, whether these firms, how fast they'll grow their underlying companies, whether they can exit them on the timeline they believe, et cetera. And so those are A, tend to be larger, lumpier cash flows, but B, come with a higher risk profile, or in
Sure.
traditional finance terms, a higher discount rate, right? And blending
Got it.
all of that together with the terminal value, effectively, if I sold the asset manager at some point in the future, what would someone pay for that? Blending all of that together builds towards the vast majority of your value. And there are some intricacies that we can go into at a later point in time, but that is effectively everything that's here. Now, the most important question is really, why would an asset manager want to sell a stake? And this is the first question that we asked. Let's take, private equity firm A, and let's say that they've been around for 20 years, one of the smartest investors in the world. They have outstanding returns. Well, if they're selling a piece of their business and they're a seller, why would I want to be a buyer? They're brilliant at investing. I definitely don't want to be on the other side of their transaction. And that is where the alignment piece comes in, right? If a manager is selling a stake in their firm so that they can take a briefcase full of cash, go sit on the beach and drink pina coladas, that's not a transaction that we want to be involved in, right? That's a total lack of alignment. I also want to sip pina coladas, but I'm definitely not going to pay them to.
Then you're
Well,
lying.
I'm guessing a good bit of the reason they want to do this is they might have a large GP commit that they have to finance,
Well,
and
that's exactly right, right?
maybe they're
That's
not,
precisely
super
right.
wealthy when they're getting started. Yeah.
Yeah. The easiest example I think that's really valuable for audience members that we use with folks that are new to the asset class. If you're going out and starting a private equity firm, and let's say you want to go raise $1 billion, the market will typically expect you to put up a certain amount of capital and invest it into your own vehicles to demonstrate that you're aligned with your investors. And let's say that's
Right.
2%. 2% of $1 billion is $20 million. That's a lot of money. And let's say that you have it. Let's say you've got your $20 million, you worked your whole life, and you're like, great, I'm ready to go. Awesome. You invest your $20 million, you raise your $1 billion fund, you go out 3 years later, everything's great. Every company you've bought doubled on paper, and all your investors are happy. And you're like, I'm really good at this. I really should go raise a second fund. And I want to raise $2 billion this time. And that's going to increase the magnitude of fees that my investors pay me. Okay, great. Well, if you go raise
So
$2
now I got 40
billion, the
million to
market
put
will still
together.
expect you to put up your 2%, which in this case would be $40 million. Now, your original 20 that you invested, that might be worth $40 million on paper, but you've sold none of it. So you're actually cash poor and paper rich. And so the real key question here is, where do you get the money to continue scaling as fast as you can? And that is where you really need to think of these transactions as growth capital. Why would a fast growing Series C company go and raise a Series D? It's not because they're trying to take beach money, it's because they need money to continue growing as fast as they can. And we can step in as an equity partner and sit alongside them and help them facilitate that growth.
And how do you think about, sort of your portfolio construction? How many different firms do you guys invest in? Do you have a minimum number of firms that you want to hold positions in for diversification purposes?
Yeah.
How much of that rolls over every year? And, sort of what's your
Yeah.
horizon?
We right now have about just over 115 different asset managers inside of our broader GP
Wow.
Stakes portfolio.
Okay.
They're not evenly weighted, right? There are 20 or 30 names in that list that dominate most of the exposure, and that's by design, right? Our goal
Yeah.
is to be diversified, but not to be diversified, if you want to use that term, that term. Um,
Got it.
but there is a significant benefit in having elements of diversification that exist across really every major bucket. So you think about, there are private equity firms where we own stakes in, there are private credit firms we own stakes in, there are real asset firms, real estate firms that we own stake in. That's maybe one dimension. You can do it by
Yeah.
sector as well: energy, consumer, technology, finance. We have that dimension. We also have capitalization. So we have a number of the world's largest private equity firms on the planet, firms like HIG and MCAP and Starwood and Clearlake. Those are, the mega cap managers. And you have a number of middle market managers as well that act as really any other middle market firm would. So you think about, standard portfolio diversification. Why do I want to own a large cap company? Well, it's wildly profitable. They've been doing this for 30 years. They know exactly what they're doing, and it's really hard to lose. That's great. Why do I want to own a middle market company? Well, they have more potential upside because they haven't yet grown into a large cap firm's valuation, but they also are still trying to find their footing in certain elements of their business. And so combining all of that together allows you to really achieve the kind of diversification that's needed in order to produce consistent results.
Do you think about
Right.
geographical diversification?
Yes. Yeah, that's another dimension that I did not say, but is absolutely real. So most of our exposure sits in the US, but we absolutely have an element of European exposure. We
Yeah,
have an element of Asian exposure, and a lot of these managers tend to be global, particularly the large cap ones. So, they may be domiciled in the US simply because their
mhm,
headquarters are here. But if you
sure.
have $100 billion plus in assets under management and every sector you can think of with exposure everywhere, you are effectively a wildly diversified manager.
If you were to map these different asset classes against like a global map, would your diversification kind of look like the market or like the map, or do you
It it
consciously over-index
does. It
any
does
place?
if you really break it apart, right? If I own a piece of a private equity firm,
Yeah,
I by extension own every fund that they have, and by extension own every company that those funds own. And so if you kind of play the deconstruction exercise down to its lowest level, we have exposure to over 10,000 underlying companies that exist across each of these managers. And that's purely an estimate. The number is actually probably higher than that, but we're overly conservative in that math. The point is that if you map that across the globe, you're really getting private equity exposure, but you're doing it in a way where you're getting paid fees, you're increasing your asymmetry, you're decreasing your downside, you're increasing your cash flow yield in a way that just doesn't exist if you're a traditional private equity fund investor.